In this video, we're going to have a look at Google. With the entire AI arms race going on right now between some of the largest companies in the world, we also want to have a look at Google. Now, of course, recently we had a look at Microsoft and realized that Microsoft at this very moment is a very attractive buy. So let's see what their competitor Google has to say about their financials, and let's see whether or not we think that Google is a good investment to buy right now and hold for a decade. So diving straight into their financials, we can see their revenue has been increasing by 17.7% every single year, starting at 55 billion in 2013, which has risen all the way to 282 billion here in 2022. Amazing growth, something that you can only really see in big tech companies. But how much of that has translated into direct earnings? So when we look at their EBITDA, we see an EBITDA of 19 billion here in 2013 and 90 billion in 2022. That is a pretty amazing margin. If we just have a look over here and we divide this number by the total revenue number, we can see here a percentage margin of 32% for the final year. And this has been holding quite steadily for the past 10 years. So overall, Google has had a profit margin of about 30 to 35%. Amazing numbers here. EBITDA grow in line with revenue growth because of course their margins remain the same. Their debt level has been very negligible for the past 10 years, which is to say they basically have no debt whatsoever. The increase in debt that we see here in 2019-2022 is mostly because we include the leases in their debt level here, but not so much because of their long-term debt, because their long-term debt is only about 14 billion here in 2022. And then when we look at their cash numbers, we see that they have a lot of cash on the balance sheet, a lot of cash which they don't quite know how to use. They have too much money that they know what to do with, which is a problem that I wish I had as well. $113 billion in cash in raw jack here in 2022. Market cap has been increasing by 12% every single year, which of course excludes the dividends. Enterprise value is the entire value of the business. It's the market cap, so the price on the stock market itself, to which we then add the debt and we subtract the cash. But what we can see here with Google is that their enterprise value is basically their market cap, because they don't really have any debt to speak of, while still having a relative number of cash on the balance sheet. EV/EBITDA ratio, they have been trading historically with a multiple of around 18 times, and right now here in 2022 they are trading at a multiple of 13 times, which is an absolute low point for them in the past 10 years, and I think this might present a very nice opportunity for us to buy Google if it remains in this multiple, and we expect it to go up here in the future. Net debt to EBITDA level is not much to say. They don't have any debt to speak of, so there is no risk of bankruptcy here whatsoever. So this then brings me to their cash flow. Cash flow has been steadily increasing in line with EBITDA because of course their margins have been remaining the same. Capital expenditure has been increasing with their cash flow from operations, which is also kind of what we expect when we look at their margins once again. From all the numbers that I'm seeing here, all I can say is that Google has been very steadily growing their business. Free cash flow from operations also increasing by 18%. Now, their share count, however, they have so much money on their balance sheet which they don't know what to do with, but yet they decide not to really buy back shares. Now, of course, when you look at the headlines, quite often you will see that Google is buying back shares, but at the same time they also hand out share-based compensation to their employees, which kind of nullifies that effect. And I think Google is very notorious for doing this. So even though they're buying back a lot of stock, it doesn't really show in their overall diluted share count because they're also offering these stocks back to their employees. So I would very much like Google to use a bit more of their cash reserves to actually properly reward shareholders and not just reward their employees. But of course it's also important to take good care of your employees, and I think Google is doing a very good job when it comes to that. Free cash flow per share has been increasing because their free cash flow has been increasing so much. The price per share on the stock market was $27 here in 2013, which has risen to a high of $144 in 2021, and it's come down here in 2022 to 89, which is also where we saw the 13 times multiple. Quite a low share price compared to their historic numbers for sure. Free cash flow yield overall has been around 3.4%, which I think is what we expect with a mature and big company like Google, which has margins of 35%. Again, the 4.8% yield is quite high compared to the overall average because their share price was so low. So let's see if we can try to forecast this business. Now, the nice thing about Google is that they have a very consistent growth in their revenue as well as their EBITDA, and their margins have always been around 35%. So we can use this. So historically, they have been growing at 17%. Now, of course, I think it's important to know that Google is facing a bit of an existential threat here by Microsoft, OpenAI, and ChatGPT. Of course, Google, by and large, is an advertising company. They don't sell software so much, they don't sell hardware so much, which of course they do sell software and hardware, but by and large, Google is an advertising business. Most of their revenue is coming from the ads that you see on the Google search page, as well as the ads that you see on YouTube. So the moment that a recession does hit, of course, advertising is going to see the biggest hit to their revenue, and this is also what we can expect with Google. Add to this that maybe ChatGPT and Bing will take some market share away from Google, which will of course hurt their top line revenue growth. So Google is not entirely without possible headwinds here in the future. I think where Microsoft had basically nothing to lose when it comes to the ChatGPT and OpenAI initiative, I think Google has everything to lose. So this is the risk that we do have with buying this stock. But if we believe that Google maintains its grip on the search engine market and we expect this growth to continue, then we can see some very nice returns. So for the first year, I'm going to grow their EBITDA by 15%, even though historically they've been doing more than this. They've been doing 16%, but I think there might be some headwinds coming up. So I'm going to give them 15%, and I'm going to reduce their earnings growth by 0.5% every single year, just to be conservative with my estimate and really see if I lowball their numbers, can I still expect a nice return. So in addition to this growth, I'm going to give them a market multiple of 18 times here, which historically they've been around 18.5 times, where for the past 6-7 years or so, they've been more around the 20 times than it is the 18 times. Of course, the 13 times here throws quite a wrench into the numbers. If we normalize that to 20, we can see an average multiple of 19 times. I'm going to give them 18 times to be a bit more conservative, but even with the 18 times, we can still expect a market multiple expansion, which will really increase our return on the stock market. So this gives me an enterprise value of, and oh my goodness, that's a big number, $5.4 trillion. To which we subtract the debt, we add the cash, gives me a market cap of $5.5 trillion. Divided by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same, this gives me a share price of $391.91. Now with free cash flow, I'm going to do a very similar thing. I'm going to grow it by 17% because historically their free cash flow has been growing by 19%, and I'm also going to reduce that by 0.5% every single year. I'm going to add a 3.5% yield to this. Historically they've been at 3.4, which is a little bit lower, so that's why I think 3.5 is a nice conservative number here. In 2022, we saw a yield of 4.8%, which is definitely high. So the yield is coming down, which is very much increasing our price target here 10 years from now. A price target of $482.82 10 years from now from holding Google. So right now on the open market, I can buy as many shares as I want for $101.97. If I take both my projections here of the enterprise value as well as the free cash flow model, I get an overall share price 10 years from now of $437.37. Simply looking at the price in the stock market itself, I expect a return of 15.7%, which is already an amazing number for a company that's already as big as Google. But of course, their share price has been hammered quite a bit recently, and it may be hammered in the future as well if it turns out the threat of OpenAI is a bit more than people were expecting it to be. If we also include the IRR, so the internal rate of return, which includes the cash flow that we might be expecting from Google as projected here in our free cash flow model, I expect an IRR of 23.6%. Now they can use this cash flow to pay out a dividend, buy back shares, do acquisitions, or simply buy down their debt. Now, of course, as we have seen, there's no debt to speak of. They are doing lots of acquisitions and they are also buying back some shares, but of course they still have a lot of free cash flow to throw around, so perhaps we see some more shareholder appreciation in the future here from Google. So this is already a very, very attractive IRR for Google, but of course it's very much stipulated on the fact that Google maintains its grip on the search engine market. If that does falter and if it does kind of move away, of course we can expect a lower level of return here. So let's see what happens if the price goes up or comes down a little bit. If the price goes down again to about $90, which it has been as around a low point here in 2022, I expect an IRR of 25.5%. Now, on average, the stock market returns about 10% IRR, so I think that Google will greatly outperform the overall index, given the assumption that they maintain their grip on the search engine market. Now, this was Google. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!